This is the biggest crash ever, and blah, 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 blah. It's a huge crash, probably the biggest since 1980. But Silver Thursday in 1980 was a bigger crash. In 1980, on Silver Thursday, which was in March, I think it was March 27th, 1980, you can look it up and correct me, we went from roughly $20.60 to $10.27. The strategic stockpile was 139 million ounces in 1985. They used that to make the Silver Eagle or coinage program. And it was depleted over several years, and then they had to go to the open market to buy silver to make Silver Eagles from that point forward. I'm not saying that they're going to try and get 140 million ounces, but maybe they're going to try to get more. I don't know. I would say round numbers, I would think at least 50, if not 100 million ounces. Now, again, how fast, because they do it over 10 years, it's really not going to put a lot of pressure on the market. It'll put some. But if they're trying to get 50 million ounces per year for the next 2 or 3 years, that may be enough. We just don't know. It's all markets move at the margin, but the more demand there is, and for physical, the more the price control goes back to the physical side.
Silver markets are drawing comparisons to Silver Thursday in 1980, when prices collapsed from $20.60 to $10.27 in a single historic crash. Analysts like David Morgan note that today's volatility reflects shifting physical supply-demand dynamics rather than pure speculation. With past U.S. strategic stockpiles once totaling 139 million ounces before being depleted for coin programs, renewed large-scale physical accumulation, potentially 50, 100 million ounces, could tighten supply. As Morgan emphasizes, markets move at the margin, and sustained physical demand may ultimately drive long-term silver price strength. Now, we present the clips from David Morgan's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think all of us really know any commodity stock that goes parabolic like silver did is going to correct. It has to. And of course, the futures markets across the board, be it the ag, softs, financials, or the metals, going parabolic, you're going to see something. When it goes that strongly parabolic, then the faster it rises, the faster it's going to come back down. So we saw a really great market in 2025, 140% up in silver and platinum. And then what we saw in January, something like a 70% move, from like 70 to 124, I believe was the high. And bang, it got hit hard on the 30th of January and got smashed over 30%. And that's a big gulp. It's really harmful to anybody, physical owners, especially people on leverage that got shaken out. But that's how markets move. So was it the banks? Was it this combination of a lot of things? But it was an overbought situation that needed to come back. So that's my take on it. Going a bit further is not everyone, but many said this is the biggest crash ever, and blah, 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 blah. It's a huge crash, probably the biggest since 1980. But Silver Thursday in 1980 was a bigger crash. In 1980, on Silver Thursday, which was in March, I think it was March 27th, 1980, you can look it up and correct me, we went from roughly $20.60 to $10.27. So we had over a 50% crash. The important point I want to make about saying that again is this. After the 1980 crash to $10.27, that was it. That ended the bull market in silver. And then we drifted lower over the next few years and more years, basically drifted down to roughly the $5 level and stayed for almost 2 decades. I mean, being a silver bull in those days was like kind of a dumb thing. You wanted to be in other assets. You want to be in other asset classes. You really didn't want to touch a market that's moving sideways for that long. Having said that, the bigger the base, the bigger the bang. When you trend sideways for 20 years, you have built such a humongous base that once you start to rise, it's really going to roar, and it has, and we're seeing that now. So the final point is this, Kai. The 1980 crash of Silver Thursday, that was that time. Now this crash this time, it is not over. I think all indications are that, yes, it hurts. It's going to take a while to rebuild a base and go back up, but I am 99.99% convinced we will be going higher. It is not the end. It's just a pause that scares people out. Lastly, that's because a bull market shakes off as many participants as it possibly can. And it's really good at shaking off the people that never jumped on the bull's back before. And what I'm referring to are the Johnny-come-latelys that are going to get rich quick and buy silver at 100 because it's going to 200. Watch it go to 120 and think they are the smartest guys on the planet, only to wake up on Monday and get a margin call they can't meet. They're out of the market. Let's start with gold. Gold is the ultimate money. I know it, you know it, our followers know it, and the banks know it. Now, who else knows it? Well, Wall Street's probably known it for a great long time, but they've never stated it before. But what happened last year? You had stalwarts on Wall Street that used to kind of make fun of guys like you and I. And now they're saying it should be 20% of your portfolio, 10% of your portfolio. Institutions should be involved, pension funds should be involved. 401ks, defined benefit programs, can add silver and gold. And now you've got silver, switching to silver in this critical minerals list. So there are so many factors. And the last factor is what happened at the end of 2025. And it was a paradigm shift. What took place is something that Peter Schiff, myself, and many others in our arena have said, that once the physical metal took precedence over the paper paradigm, we would have a brand new market. We did. And we had it for several months based primarily on commercial bars, which are backed by paper, being added to industry, perhaps private hands, both, to take control of the price. So we had a price discovery going on for a very long time. But as that physical methodology did take control for quite some time, the paper paradigm kept building and building, which you already addressed earlier in our first question out of the box. But nonetheless, now we have a struggle. Who's going to win the battle? Well, the physical market will win the battle. And that's why I'm so bullish that we still have not ended this. It's not a 1980s. Hunt brothers, get brought up before Congress and have to testify, and they're banned from ever trading silver again the rest of their lives. And there was too much paper in that system. There's probably too much paper in this system. The problem this time, different than the hunts, is that the physical demand is so strong, unabating, and rules are changing in China, as far as I understand it, as far as how much leverage you can use at the downside. So there's a lot of factors this time that weren't around. And the last one is very obvious, but it remains to be stated. You had a Hunt brothers and some Saudis involved in the 1980 market. Today, it's a global market. Solar, AI, EVs, all electronics are leading that market. It's a 65% demand that isn't going to go away. Whereas if you look back in 1980, I forget the exact number. I know that in 1990, it was about 30% of the market. Now it's double that amount at least. And the supply chain was about 500 million ounces annually. And now it's about 1 billion ounces. So it's twice the demand on twice the amount produced. So that's a lot more metal that's demanded today than there was back 25 or back in 19. A lot of people don't know this, so I'm going to digress a little bit, but it's important to understand. And in fact, there's a paper on the silverinstitute.org's website. You can find it. I forget the title of it, but it's type in what you just said, Kai. Why did silver deficit not move the price? And I think it'll bring up the article. The article's probably 3 or 4 years old in my memory. But we had a physical deficit for 15 years in silver. From 1980 to 2005, those 15 years, we had a structural deficit in silver of average of 100 million ounces a year. As you just said, this time it's 200 million ounces a year. But remember, we're mining about double what we used to back then. Regardless, 15-year deficit and the price hardly moved. So what happened? Well, to make supply and demand equal, which they must, we had roughly 2 billion ounces in fine silver in the silver category commercial bar market at the high in 1990, and we just drained it away. So we ate up 1.5 billion ounces of silver under those 15 years, and the price didn't hardly budge. Why? That's the big question. And the answer is because the paper paradigm worked so well, the banks had so much control, and more importantly, anytime the physical demand was made, which obviously was made, averaged 100 million ounces a year, there was enough silver to supply the needs of the physical offtake from the COMEX, London too, but let's just say from the exchange and the LBMA to meet that demand. So even if it's the last car on the lot and you sell it, but there's no more demand until you can restock, you've met the demand and everything can be copacetic.
After a parabolic 140% surge in 2025, silver's sharp 30% correction echoes historic volatility seen during Silver Thursday, when prices collapsed over 50%. Analysts like David Morgan argue this is not the end of the bull market, but a necessary shakeout. Unlike 1980's Hunt Brothers episode, today's rally is fueled by global industrial demand, solar, EVs, and AI, plus sustained physical buying. With structural deficits and rising investment interest, Morgan believes silver's long-term uptrend remains firmly intact. Let's get back to the interview.
First of all, a lot of people don't know that Samsung had an offtake agreement with Avino Gold and Silver years ago, and readers of the premium service, the paid service, know that because we featured Avino in our list many times, on and off. But now they've added another one, and then you've got other entities, smaller mines that have been approached for offtake agreements. So I think the Trafigura, Glencore, all these intermediaries that really, I won't say control, but certainly have access to the physical metal. And they're sort of in the dark. I mean, most people don't know how that actually works between, doré or concentrate getting refined in China, and that metal never hitting the exchange. It doesn't go to the LBMA. It doesn't go to COMEX. It goes to a manufacturing concern or somewhere else that needs the metal for industrial purposes. Why does it have to go on the shelf first? It doesn't.
Do you see the U.S. actually starting to stockpile silver? So far, there has been no mention of it as far as I'm aware of.
I do. I had Mike Dorenzo, the CEO, president of the Silver Users Association, on our mastermind about a week ago, maybe not quite a week ago. And I asked him that question. He kind of picked up his voice. He didn't yell at me, but he said, "There's nothing that says they have to stockpile it." Then he kind of calmed down, and I believe that they will. And he said yes, that just because it doesn't say they have to, he thought that they would as well. But the question becomes how soon and how much. So they're going to grab 100 million ounces in a year's time, or they're going to grab 30 million ounces in 3 years' time. We don't know the answer to that, but I do think that they will certainly stockpile silver. I think that may lead to other nation state asking the same question. Well, if it's strategic to the U.S., is it strategic to us? So there could be other nation states that are saying, hey, wait a minute, we love gold for monetary purposes, but we need silver for strategic reasons. Maybe we should jump in there as well. Just for final statement on that whole idea, the strategic stockpile was 139 million ounces in 1985. They used that to make the Silver Eagle or coinage program. And it was depleted over several years, and then they had to go to the open market to buy silver to make Silver Eagles from that point forward. I'm not saying that they're going to try and get 140 million ounces, but maybe they're going to try to get more. I don't know. I would say round numbers, I would think at least 50, if not 100 million ounces. Now, again, how fast, because they do it over 10 years, it's really not going to put a lot of pressure on the market. It'll put some. But if they're trying to get 50 million ounces per year for the next 2 or 3 years, that may be enough. We just don't know. It's all markets move at the margin, but the more demand there is, and for physical, the more the price control goes back to the physical side. And last thing you didn't ask is that in the United States, I think it was February 1st, Kai, the defined benefits program, in other words, called 401ks in the United States, can't add, not necessarily they will do it, but some will, gold and silver as an option for the savings plan. So that is a big market. These are big corporations that have these pension programs for employees. I mean, we're talking like Ford Motor Company, General Motors, 3M, Dow. I mean, all these big corps that have lots of employees that have the wherewithal to do these type of things. So that's a lot of pent-up demand that someone that's worked there for 20 years, 30 years, 5 years, just entering the workforce says, wait a minute, my option stocks, bonds, money market or gold and silver program going into gold and silver. Well, multiply that times the amount of people that would be steadily, consistently buying gold and silver month over month, year over year, and what that would add to the physical demand. I think it's important to bring that to the fore.
David, maybe last question here. Like, what is something you're most excited about or most concerned about over the next 12 months when it comes to the precious metals in terms of like news flow that could impact the price positively or negatively here?
Most concerned about maybe would be something in the solar industry that's a real breakthrough that's easy to achieve in a short amount of time. So there's some, copper wire that's coated by silver that has 90% of the same output as a current solar panel with the same longevity, and it cuts the price in half. But if that were to occur, you got to think it through. That would probably mean they just keep building more solar panels. So maybe the amount of silver would still be in the long run the same amount. So that would be one concern. So there was a negative. I think the positive is just maybe a slow grind. I mean, I don't like the parabolic moves that much, but a steady eddy moving higher for both the metals, and maybe some rationalization amongst nation states where the new proposal, rather than being a CBDC, is a private system where people have their financial anonymity intact, and it's connected to gold in a real way that could be, let's say, audited, where people are satisfied that it's the real deal. That would be my wish.
Silver markets are tightening, as offtake agreements bypass exchanges like London Bullion Market Association and COMEX. Firms such as Trafigura and Glencore secure physical supply directly for industry. Potential U.S. stockpiling and expanded 401k access could add steady demand. While solar innovation may reduce silver per panel, overall deployment growth could offset it. Rising physical demand may gradually shift pricing power away from paper markets and toward real-world supply constraints. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.